key area of discussion in markets over recent months has been where are we in the economic cycle and what are the implications for markets. In this video, we're going to look at some of the signposts for recession and try to build up some idea as to timing of the next recession in the US. So let's just have a look at this current recovery in the US. So there's been much talk about the duration of this recovery being the second longest in the post-war period, and it's 36 quarters long. The compound growth rate has been 2.2%. So a couple of observations to make here. Well, particularly the fact that it's been a lot lower than previous recoveries, the growth rate that is. As you can see here, going back in the sort of 60s and prior recoveries, average growth rates have often been 3.5%, 4%. So this one at 2.2% is quite slow by historical standards, even though the duration of this recovery is certainly up amongst the best. The cumulative growth in the US economy since this recovery began is about 21%. So it's also been quite a good, solid, and but gradual recovery. So what are the indicators that we should be looking at for perhaps some signs or signposts of an imminent recession? So if we look at the US equity market itself, what we're doing here is on the bottom scale, the quarters pre and post the beginning of the recession. Beginning of the recession, which is these recessions named and color-coded down the bottom, is at 0.0 and beyond. So these are the 3 quarters, 6 quarters, 9 and 12 quarters prior to the recession, and these are the changes in the actual variable. So the US equity market has on average peaked, the bold red line is the average in all of these charts, has peaked around about 3 quarters prior to the onset of the recession. So let's have a look at perhaps at some of the signals, and people will often talk about the yield curve as being one of those. I'm including the early 80s here, but as you'll see shortly, I'm going to actually remove those. I guess a different policy environment where we had very high inflation with the central bank very much focused on killing off inflation. So I'm going to drop that from this particular event analysis. And so now what we're looking at is the yield curve since the 1990s, the 10s minus 2s, and it's basically gone inverse. There's the 0. It's basically gone flat to inverse about 5 quarters prior to onset of the recession here. Now, where are we at the moment? Well, if we look at this chart once again, the curve is sitting at about 55 basis points at this point in time. So you can see here that if we use 55 basis points as the average, that puts us about 7 or 8 quarters prior to previous recessions. So that's the yield curve. Now, if we look at a couple of other measures, I'm going to look at the output gap as being one of those. Again, we're only looking at the 1990s onwards, and the output gap, the US economy relative to its potential is pushed above that. The red line is the average, about 7 or 8 quarters prior to onset of the recession. You can see here. If we go back in time, you can sort of see those the output gap. This is the actual output gap series, so moving up to its potential, beyond its potential, slightly beyond its potential, and recessions followed. So the US economy arguably is not far away from reaching its potential growth rate. We would suggest that another 6 to 9 months is likely to see it in line with this measure of potential. And if that's the case, then it starts to put a recession sometime around mid-2020 on that basis. NAIRU, looking at NAIRU relative to the actual unemployment rate is another way of looking at this question. And as we see here, there's the recession, beginning of the recession, 0.0. Around about 9 quarters or even a little bit more prior, the US unemployment rate has gone through the estimate of NAIRU. Now, at the current point in time, the US NAIRU is estimated to be around about 4.3. There are suggestions that it's actually lower than that given the lack of any evidence of wage increases. So it may well be, but it's sort of sitting at about 50 basis points below the current estimate. So when that's happened in the past, that's about here, about 50 basis 0.5% below NAIRU. That's typically been about 7 or 8 quarters prior to onset of recession. So if everything follows the past, certainly the 1990s onwards experience, it once again points to a dating around about late 2019 to mid 2020. The real Fed funds rate, of course, is the other key component that's going to be related to those measures that we've already discussed. Fed funds relative to neutral has moved, well, it's moved to a restrictive policy stance around about 6 to 7 quarters prior to previous recessions. And in fact, it's got about 100 basis points restrictive or 100 basis points tight. As you can see here, that's 100 basis points. So if neutral is considered to be 2.5% in the US, then it would suggest that a 3.5% rate on the Fed funds is likely to be seen in around about 3 quarters prior to an eventual more significant downturn. So finally, the yield curve, and we only have two in this sample for the US high yield market at least. And it doesn't seem to be a great indicator. It's a good contemporaneous indicator of recession, but it doesn't provide much of a lead. And in fact, you can see here spreads, this is high yield spreads, have really only started to kick up in the sort of 1 to 2 quarters prior to the past two recessions. And then they certainly take off once the recession hits. So I wouldn't see this as a terrific indicator, and it's certainly the case if we look at triple B 10-year spreads going back even further. I think we'll see some of those if we incorporate all recessions. There's no real strong tendency or a lot of information in movements in spreads, we don't believe, at least from a longer term point of view. Just going to finish up with another look at a range of different indicators. So if we're defining the event or the regime as a US recession, and I'm interested in what's happening to a range of indicators in the 30 months prior to the recession. There's my series that I'm going to look for. I'm going to categorize them in terms of first quintile, so very high or very strong, down through to the fifth quintile. And if we run that analysis, what comes up the highest, if you like, is the 12-month change in the Fed funds rate. So when the Fed funds rate is increasing at a fairly rapid pace over a 12-month period, what this has found is that 70% of the time, the event being US recession has occurred within a 30-month time period. So if we look at that graphically, we can see the top part of the chart, shaded areas are for the recessions. That's the GDP line there. And below, the pink area is the 30 months prior to those recessions, and the bold red parts are the periods where Fed funds rate is increasing at a first quintile pace. So it has been a pretty good indicator, as we can see here. There has been occasions where it's been on, yet there hasn't been a recession in the around about 84, 85, and then again in the early 90s or 94, it provided a false signal. And we're not there yet. Obviously, Fed funds have increased quite a bit, but not to that extent. So what are the other good ones? Well, we talked about the yield curve. Once again, so this is yield curve in the fifth quintile, so a very flat to inverted yield curve. It's occurred in those 30-month windows prior to recessions on each of these occasions and hasn't really given a false signal. So we're not quite there at this point. And then the GDP output gap, actually we'll use this one. That's one we referred to earlier on. So the output gap being in the first quintile, so quite a strong economy relative to potential, certainly in the 1980s, preceded recessions. Wasn't quite there in the late 80s, but it would have been in the second quintile. Here it was first quintile in the late 90s. Here it would have been second quintile, and as I said, we're approaching that level again. So this is just another way of trying to determine what factors or what indicators might be useful in trying to have some sort of projection of the next US recession. Thank you.